Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. Now, yesterday I began a series. This is going to be about a 5-part series where we go through each individual pattern, and I'm going to offer you guidelines on how to actually trade that specific wave pattern, mainly by identifying entry points and also 2 initial protective stops. Now, you can find more of this type of information again in my book, The Visual Guide to Elliott Wave Trading, and if I recall, you can still get it on Amazon if you're interested. Now, as far as today's lesson, we're going to be moving on. Yesterday we discussed how to trade the impulse wave. Today we're going to be looking at how to trade the diagonal, and that would be this pattern right here. Let me go ahead and highlight that for you. Remember, this is an ending diagonal. It is one of 2 types of motive wave structures, and it always occurs in the final wave of a sequence. So it's limited to as it may form, and being in the 5th wave position of an impulse wave, or as wave C of a zigzag or a flat correction. So let's take a look at the basic underlying pattern. Again, this is a diagonal. Old school technicians refer to this as a rising wedge. Elliottians refer to this as a terminating wave pattern, again, because it's limited as to where it may actually occur. Wave 5, wave C of, again, either a zigzag or a flat. So here's the question. We know the pattern. We've learned about the pattern. And again, if you do not have the book yet, the Wave Principle by A.J. Frost and Robert Prechter, I highly recommend getting the book because there's no other better treatise on understanding the nuances, the rules, the guidelines, the principles behind the wave principle as set forth by Ralph Nelson Elliott than that book, Elliott Wave Principle. Now, that will give you the foundation that you need to understand the wave principle and also, too, how to apply it correctly in a real-world market environment whenever you're looking at, say, open, high, low, close price charts of crude oil or currencies or commodities or individual stocks. Okay, but where that book stops, my book begins, and that's to take the wave principle and then begin to turn it into an actual trading tool, because that was one of the things that R.N. Elliott, his life was somewhat cut short. He wasn't able to take the next step. What he offered in his original work was a very, very powerful and a very, very accurate forecasting tool. A forecasting tool is not a trading methodology. Okay, a trading methodology basically identifies trade setups, lets you know what your entry should be. It allows you to identify risk reward. It identifies initial protective stops. Trading is much, much different than forecasting. Okay, forecasting is basically the art/science of identifying potentially what could happen. Trading is more focused on what actually is happening. Big, big difference, but a very, very subtle difference. So here's the ending diagonal that we have in the diagram. Okay, so how do we trade it? Well, as always, there are many different ways to actually trade a diagonal, and I'm going to talk about 3 or 4. One thing that I learned a long, long time ago is, and I kind of remember being in the same situation myself initially, where it was just like, okay, hey, somebody teach me what the best entry technique is. And once I learn that single best entry technique, then I've got the discipline to follow that and do nothing but that. Ultimately, I learned is that there's not just a single best entry technique. There are multiple different entry techniques. There are multiple different ways to identify protective stops. There are multiple of ways, many, many different ways to identify risk reward and how to manage risk once a position is actually taken. There's not just a single best way. Ultimately, you're going to have to figure out what works best for you. Okay, so the first entry technique on trying to capitalize on an ending diagonal pattern would be what I would consider to be a very aggressive approach. Okay, so what you're doing here in this instance is you've identified wave 1, 2, 3, 4. You've drawn your trend lines, your 2-4 trend line, your 1-3 trend line, and the market is beginning to inch higher and higher and higher. So as this market is moving up, that's where you basically go ahead and enter a short position, because remember, once the pattern is complete, you're looking for a complete retracement back to below the origin of the pattern. So once the pattern again is done, you're looking for something along these lines. So again, this is a very aggressive entry technique, trading specifically the ending diagonal pattern. And again, this idea is just simply, as the market is moving up in wave 5 of the pattern, you go ahead and begin to accumulate a short position, and your protective stop is at this point here. Why is that point significant? It just looks like a horizontal line in the air up there. Well, remember, within an ending diagonal, it has a very specific set of rules and guidelines which actually govern its development. And one of the rules is that in the contracting triangle variety, variety that we're looking at here, wave 3 is going to be shorter than wave 1. So by default, wave 5 must be shorter than wave 3. Because if wave 5 exceeds that level, where wave 5 becomes longer than wave 3, guess what? It's not an ending diagonal. Okay, so this is again a very aggressive trading style, because you're basically getting into the market before a top has actually been made. Okay, but this is a viable technique, and again, it's a very aggressive form. You're basically scaling in prior to the culmination or the completion of the pattern, but you have identified your protective stop, and that would be the point where 5 becomes longer than wave 3. Okay, now here's another technique which is not as aggressive as what I just showed you. It leans a little bit more to the conservative side, but it's not conservative enough for me. Okay, and that would be this one, where essentially what you're looking for would be closing price action below the 2-4 trend line. So you see the 1, 2, the 3, the 4, the 5, you start to come down, and then you get closing price action under that 2-4 trend line. Well, that could be an entry technique, and again, your protective stop is going to be the high, the high of the move. Or you can actually wait till maybe say the high of a price bar is below that 2-4 trend line. So this technique here, it's not as aggressive as what we just discussed, but it does give you, it does allow a little bit of confirming price action to actually take shape and occur. Now, my technique, and this is the technique I go through both techniques and even this third technique in my book, The Visual Guide to Elliott Wave Trading. This is my technique. Again, my whole approach to trading is because I know how easy it is for things to go wrong and go south, and I know when that happens, it is often quite expensive. I take a very conservative approach to trading. In fact, the way I describe trading is trading a good trade setup. It's like a party. I want to arrive fashionably late, and I want to leave before the cops show up. Okay, so I'm always going to be late. As far as catching the turn of a trend. I'm never going to bottom tick the market, and I'm never going to top tick the market. That's not my job. That's not my goal as a trader. What I'm looking to do is basically look for that trend to reverse, look for the confirmation that the trend is then reversing, act at that point, and then ideally capture say 60 or 80% of the price move. And then after that, game done. I've done my job. I've made the cash register ring. So I don't have any interest in bottom ticking the market or top ticking the market, but I do want to capture a significant portion of a trending market or a trending price move. So this is a more conservative approach, and it's very similar to what we discussed yesterday, where we were looking for, with 5 waves up, you're looking for prices to fall below the wave 4 extreme of the final 5th wave move up. Well, here I'm looking for prices to fall below the extreme of wave 4. Once this event occurs, again, I consider the market to have given me a green light in anticipation of taking a short position. Because remember, what I'm doing is I'm looking ultimately for a move back to below the origin of the pattern. So here would be my, again, not necessarily a trigger where I have the order in the market at that point. That's not what I do. What I simply do is I want to see this market come down in 5 waves, and I want to see that wave 4 extreme exceeded. And then at that point, then again, I consider the market to have given me permission, given me a green light to begin actively looking for an entry point. Okay, so basically here's your entry, here's your protective stop. Now, here's a fourth technique. And again, this is probably the most conservative, where what you're essentially doing is you're waiting for prices to fall below that wave 4 extreme. And then you want to see this decline, of course, unfold in 5 waves. And then following that 5-wave decline, you're going to look for a 3-wave countertrend move. And ideally, this is going to prove to be 1 down and 2 up. So when this happens, you have your move down, you have your 3-wave countertrend move up. You can enter pretty much any time in this area here, of course, with the high being your protective stop. Okay, and again, what you're doing here by, again, waiting to pull the trigger, you're just waiting for more price evidence to occur that supports your assessment. That increases, odds in your favor of this proving to be a very successful outcome. Okay, so one thing that I strongly urge all traders to kind of relinquish is that mindset that you have to get into the market right now today, because if you don't, you're going to miss the opportunity. That is called FOMO, of course, fear of missing out. That can certainly sabotage any trader's success. There's always going to be another trade. There's nothing wrong with waiting if you miss a trade, because many times I've actually applied this technique and I've seen the 5-wave decline and I've waited for that 3-wave move to develop and it never happened. So I missed the opportunity altogether. Guess what? There's always going to be another opportunity. So if you miss one opportunity, look for another opportunity. Okay, the markets are going to be around for still quite some time. So there's no rush. Never, ever, ever be in a hurry to get a position on. In fact, again, my trading style is I like to be late, because it's that additional time that I give a setup to mature that either supports my original assessment or possibly something might happen that go, oh, I didn't see that coming. I don't think I want to take that trade now, only because I waited, maybe 2 or 3 days before actually pulling the trigger. So again, here are the basic, say, setups or techniques for entering a trade setup to the sell side based on an ending diagonal in, say, the 5th wave position of an impulsive structure. Again, each one can be tailored to your own personality, trading style, whatever. If you're very, very aggressive, then you're going to be looking for something like this. If you're not that aggressive and you're looking for maybe something more conservative, then you'll be looking at a possible entry technique like this, or perhaps this. Now, tomorrow we're going to be doing the same thing, and I'll be showing you how to take advantage and trade a zigzag.